Hey traders, Todd here. Welcome to the free video update. It's now Tuesday the 6th. Hope you're well. And let's get into it. We're going to talk about the consumer discretionary stocks. We're going to talk about Spotify. We're going to talk about not consumer discretionary stocks, but related to the theme I want to drive home for you is Amazon and Netflix, and specifically the consumer. We'll look at some growth value. We'll look at the two macro influences that are giving the market pause right here. There's a lot I want to share with you. It's really important, I think, to sort of go into this area of the market. So I think 2024 is so far is continuing to be driven by AI. The massive AI boom here that has likely a long way to go. But I think the other theme that's driving the market this year is the question of the health of the consumer. Okay, and the idea here is the market is going through a realization that they're not going to get 5 or 6 rate cuts, which was really obvious to us. And we're watching the market go through this discovery process of, oh, wow, we might come out of this year, with 4.75 on the Fed fund rates, or 4.5% on the Fed fund rates, right? So the function, that realization is going through the market, and that's going to shape the depth of any correction that we may have, or maybe it's just sideways, right? So the idea is that the consumer is going to be really squeezed if we leave rates where they are. Inflation continues to roll 3.5%. And so many people are looking for recession here based on those factors heading into 2024. And of course, we have a very big election here in the back half of 24, right? So what I'm thinking about is the recent jobs report. Non-farm payroll came in double expectations, both on the private payroll and on the headline, right? And the other part that really hit home was average hourly earnings. Month over month was double expectation, and year over year was well above. So the consumer is still making money, and the markets don't like that because they're going to continue to drive inflationary pressure, which is going to push those rate cuts further and further out, only further accelerating this circle of the consumer's ultimately going to be in trouble. Now, we've been really focusing on consumer discretionary stocks, and I want to go into it here in just a sec, but there's sort of a differing message that we're getting from large cap consumer discretionary stocks, and let's call them mega, and even some of the largest caps below that are giving us a different message. So let's just leave the intro there, and let me roll in, if that's okay. All right, here we go. 1080. There we go. All right, first I want to look at growth value ratio. This is my favorite chart out there. Okay, so we're looking at the value growth ratio in black. Okay, as the black one is dropping, value is underperforming relative to growth. Growth is outperforming to value. And as you can see, we've overlaid the 10-year yield, and this was back in 2018, 19. Here's the pandemic. So yields dropping, value underperforming growth, growth outperforming value, which is what you'd expect to see in a lower yield environment because it's easier to justify higher valuations, excuse me, of those growth stocks, specifically in tech comms and some consumer discretionary. All right, so 10-year yield starts to move up, questioning those valuations, and that drives the rotation into value out of growth. That was fine up until just about January of 23, about a year ago. Yields said peace out, kept going, and then the market rotated back into growth out of value quite sharply. And you can see in the most recent spout of earnings that we've got a new low in value growth, which means a new high in growth value. Now, the U.S. 10-year yield is acting spicy here. Okay, it's acting spicy. That's the one thing that's causing hesitation in this market right now is the U.S. dollar is pushing higher. Yields, not to the same extent. 10-year yield is pushing up above like 4.1 to 4.2. And that's a reflection of the realization process that we're going through that the Fed isn't going to cut rates anytime soon. So yields are going up, dollars going up, and that's just basic macro relationships, and that's giving the stock market pause right here. Okay, now I just got off of the member video, and we did a macro overlay of gold, crude, dollar yields. Dollar's going it alone right now. Yields aren't making a new high. Crude's not making a new low. Gold's not making a new low. We're not getting intramarket confirmation that the dollar can continue higher. So I don't think it's going to turn into anything significant. Okay. So just opening up the conversation here with the macro sort of growth value preference, because clearly yields, as we look at this, clearly yields are going to be driving or have a big impact on the market's preference for value or growth. Right now, it's still growth. Okay, so let's take it one step further and break into value growth. All right, now look at the rotation of value growth. This is the weekly RRG. Okay, so this was September 23 Q4, and then you can follow the date right there. So October, then we get a hook higher in growth, lower in value. We got a little bit of a move here in the first week of this year. We got a little bit of a hesitation right here. It was this right here. But now we just got a hook back in growth and a pretty good acceleration out in value. So it looks like this rotation that was trying to move out of weekly weakening up, picking up momentum, and then we just started to make a north-northeast heading back into leading. That's still alive and well. So that's confirming what we're seeing, the market's preference for growth. Okay, now let's get into the sectors. Tech and comms are fine. Okay, comms are very good. We're going to talk about comms in here right now, obviously with Meta and Netflix. We'll talk about that. So XLC making a nice rotation up. Tech is residing out to the right, which means it's stronger than everything else on a relative strength point of view. The fact that the arrow's moving down, the tail's moving down, means it's losing momentum, but it's still in a position of outperformance. And all we would need, which would be awesome, is a hook back in that direction. Now, it'd actually be cool to see if it hooks left or right, but I'd love to see it hook this way, which is actually pretty unusual. So tech and comms are fine, but the big wild card again is this XLY. That is an offensive, cyclical, growth sector that we really would like to see participate in that growth rotation that I just showed you. Now, consumer discretionary is a huge sector. There's a lot of different kinds of industries within consumer discretionary, so it's a nuanced conversation, okay? Now, if we look at the top 10 market caps of XLY, all right, and we have XLY in here, which is that purple guy right here. Now, the headings, the location, all very important. There's a lot of sort of negative developments here on the consumer discretionary RRG on the weekly here. Most notably Tesla, no surprise there. Starbucks, I just cut that from our wealth management holdings. Starbucks has been a loser. Nike, same thing, horrible looking chart. TJX companies trying to make the hook, but still down in weekly lagging, no good. Lowe's, just certainly trailing where Home Depot is. Home Depot looks okay. Looks like it's starting to roll over. McDonald's doesn't look good. And then Chipotle, same thing, just residing way out to the right, but just losing momentum. Booking is probably the best one of the large cap consumer discretionary stocks out there, and it's making a little hook along with Amazon that just made a little nice hook here. It's a tough color to see following those earnings. So overall, I would love to see CMG hook. Bookings looks better. I like the chart setup. Amazon looks good. However, Amazon is in a pretty significant 5-wave move into the 170, 175. We'll talk about that in a sec. I wrote an article for CNBC about that, and we just did a call credit spread, sort of an income trade above wave 5 resistance in Amazon. So there's a lot of stuff going on here in the consumer discretionary, which is giving us pause. Now, here's what's crazy. Okay, and here's where it gets just wonky. You get to see my notes. That's fine. I don't mind. And there's so much in here. I'm gonna have to read it anyway. So, Amazon, and here's what's interesting. The message on the surface that XLY is giving us as we went through those top 10 market caps is one that the consumer is not going to be able to hold up with continued high interest rates. Okay, but if you look at these three companies, Amazon, Netflix, and now Spotify, which just reported, they have three things in common. Amazon came out and they were looking for significant growth on advertising buys on their Prime and specifically Prime Video offering. Okay, and I have a slide here that we share with wealth management clients, and I'll share it with you. Present. Okay. I wrote an article. This is something I wrote for CNBC. The street's looking for 81 cents EPS on 166 billion. Here's the key. A big boost to the advertising segment after the intro of ads to its quickly growing Prime Video and Prime Membership segment. Advertising segment is growing at 26% year over year. That should be year over year. Even faster than Amazon Web Services at 12%. And considering the growth numbers Netflix reported, expectation is favorable here. Well, they were looking for 26 and they came in at 27. And they crushed EPS and revenues. So, and we hold a 5% allocation in our tactical alpha growth. So what that means is this. Companies are buying ads on Prime Video because they wouldn't do so if they thought the consumer is about to drop off. Ad buys on these platforms, I think, are a leading indicator to how businesses who buy ads view the health of the consumer. So Amazon just crushed it. Netflix, also, they kicked off earnings early on in the season. Ad-supported tier amassed 15 million in global monthly active users, and they're moving into this cheaper ad service that had huge growth. The notes that I took down is triple the most recent figure in May. Notable growth for Netflix as it lapsed a year since rolling out the new subscription option. So it was massively bigger on the ad-supported tier. So when Netflix sells more ad-supported services, right, the ad-supported tiers, media buyers are going to see that and they're going to increasingly advertise on Netflix. And then the last one we just got was Spotify. Okay, Spotify, their earnings were horrible, but their total monthly active users rolled 23% year over year to 600 million. Ad-supported MAUs grew 28% year over year to 379 million. Premium subscribers grew 15% to 236 million. The point as I kind of arrive into the finish here is largest cap consumer discretionary stocks look awesome, like Spotify. Okay, Spotify, I think we're in a third of a third. And if we look at minor three, a quality 100% 3v1's at 339. I mean, that's the minimum target for a wave three. Okay, and that's going to be just shy of all-time highs, which, 340, 350. A wave three should go 1.618 the distance of wave one, and that is, I don't even want to tell you the price. That's significantly higher, right? So, you look at that and you say, okay, I hold Spotify in the wealth management. I'm going to be looking for short-term trade opportunities to get up to 339. Netflix, just mentioned that one. It's a communications company, but the story's the same where their ad buys, their monthly active users, the consumers spending more on these discretionarily, these elastic services that can be cut if they were in trouble. And of course, the media buys that I just mentioned are also strong. So companies that advertise are betting on the consumer, right? So Netflix is through 786 retracement of the all-time highs to lows. I don't see why we wouldn't be targeting 650 to 700 in Netflix. Amazon, same deal, really good quarter. I'm a little concerned on the 5-wave move here. This is purely a technical conversation. 170 is significant resistance of this 5-wave move. I did a little 170, 175 call credit spread that goes out 2 weeks, just a little income play to see if that sort of hesitation in a large cap within consumer discretionary will let us sort of sell off. And remember, this is one of the most important 5-wave moves. It's similar to Microsoft and a few others from the late 23 move. So we have 5 waves up. If this market doesn't respect it, and if it invalidates this incredibly obvious Elliott wave count, we're going to have to go back to the drawing board, and the large cap consumer discretionary stocks are joining the party, and that hesitation we're seeing is ending, and XLY might join the party, and that completes the trifecta for the growth trade, which is tech, comms, and would-be consumer discretionary leading, and it's party on. So I know there's a lot there, but that's the kind of market we're in there, ladies and gentlemen. I hope you're doing the work. It's really, really awesome in here. Super. I can't remember such a fun, exciting market. I can't remember the last time I've been so dialed in to this market, and it's been awesome. So, all right, let me know what you think. Take care, guys. Thanks.